Hello, this is Doug Gerlach from iClubcentral. Welcome to our Investment Club webinar. Today is Tuesday, August 16th, 2022. Tonight, we're going to be taking a look at creating an investment policy statement for your investment club. This is a task that I think is very important for members of investment clubs to undertake on behalf of their clubs so that the club has a unified sense of purpose about their investing goals, their approach to investing, what's prohibited, what's allowed within the club portfolio. So this is part of an extended conversation that you and your club members can have, but we're going to go over the high points, define what a policy statement is and how it works within your investment club. As always, I'll be joined tonight by Russell Malley, who is our club accounting advisor, and Sean Pulrang, who's our senior support representative. They are answering questions in the back office. And if you have any of those questions, please feel free to type them into the GoToWebinar application in that questions box. There is a handout for tonight's presentation that you can also download from the Handouts tab. Look for the little Adobe icon and click that. You can save it to your computer, quickly print it, or store it away for future reference. That handout will be available when we archive this video on the iClubcentral YouTube channel as well, so check the description there if you're not participating in the live presentation. So what is an investment policy statement? Well, we're going to define it as a document that's often used in the financial industry by professionals. They use it to communicate what is allowed, what's prohibited in terms of strategies and securities that govern that relationship between the financial professional and their client or customers. When you look at financial advisors, portfolio managers, mutual fund managers, pension fund managers, other institutional investors, they will utilize this investment policy statement. Sometimes it'll be customized to the customer needs. Often it's provides the guidance that, for instance, mutual fund shareholders can review to understand how a mutual fund is invested. So it has a lot of uses within the industry. And it's an important document because it helps make sure that there's clear communication between the goals of the customer and the role of the financial professional who is working with that client. It'll prevent discord, it'll prevent second guessing, it'll prevent the questions, why did you do that? I didn't think that's the way things were supposed to work. So it's very useful in terms of that relationship. But I think for an investment club, it's also a very useful document to have and to develop within your club framework. It enforces consistency in the club's decision-making because everyone needs to be on board with the procedures, the objectives of the club, the goals, and how the club intends to reach those goals. And consistency is really key to developing a successful financial portfolio, whether you're in a club or or investing on your own. Having a consistent, disciplined approach is really important. If you are scattershot about your investment decisions, if you're buying every stock that piques your interest, you're not building a portfolio that will stand the test of time. An investment policy statement within a club also prevents the club from getting sidelined in investments that are not suitable for the club. And we've seen this in the past where clubs disband because there's an inconsistent strategy. There are members who don't agree with decisions that are being made. There are members who want to introduce the club to other arcane or difficult strategies that are hard to undertake within a partnership. And so the investment policy statement can really guide the club and keep the club on track. An investment policy statement is also useful for new member recruitment because it gives new members a better understanding of how you're approaching building a portfolio within the framework of the club. And this will often help you narrow down the suitableness of a particular individual who might be interested in joining your club because they might be more interested in some other types of securities, or they want to trade options, or they're interested in investing in commodities, which are outside the purview of your particular club as defined in your investment policy statement. Those are just a couple of examples. Now, every club is going to have slightly different policy statements, slightly different guidelines, and that's perfectly fine. That's why we're not presenting a sample investment policy statement in this presentation. We suggest that you figure it out on your own, what's important to you, and we'll give you the guidelines and considerations that you can utilize along the way. And it's been said that experience gives you license to deviate from the rules. So if you are a member of a club that is very experienced, that has a lot of experienced members, feel free to deviate from the suggestions. If you're a newer club and you don't understand a particular suggestion we're making, that's your cue to research that particular item and then understand it before you incorporate it in your suggested guidelines. But as we're saying, nobody is going to agree 100% with my suggestions, with the suggestions that the iClubcentral team has put together in terms of how to run your club. It's your club, so all that we can do is point out the downsides and ramifications if you make particular investment decisions about certain securities and how that impacts your taxes. But whether you move forward or not, that's completely up to you and your fellow club members. So with that introduction underway, let's talk about creating an investment policy statement. Now, policy statements can change over time. This is not meant to be a fixed document. It will be something that you refer to. It can be amended or edited over time, especially as a club learns from its experiences, from the decisions that it's made. Those policies that you so carefully craft may change, and that is okay. If you're a new club, you don't have to be exceptionally specific from the get-go. You can create a general document to start and then fill in the blanks later on. Refine it as you gain knowledge and experience in the markets. If you are undecided, Better Investing and iClubcentral offer sample partnership and bylaws, which provide the basis for many of the decisions that you'll be making with respect to an investment policy statement. And that's a great place to start if you are new to the investment club concept. If you're an established club, the creation of investment policy document is something that you can undertake over the course of several meetings. You can convene a committee to put together a draft. You can discuss it within your club meetings, a couple of topics at a time in the context of an educational presentation. And that will, again, bring everyone's knowledge up a little bit as you do that. And then once everyone has a pretty firm understanding, you can finalize your particular statement. So we're going to look at 8 key elements of an investment policy statement. And these we'll go into detail in each of these particular elements, and I'll raise the questions that I think you should be addressing and what you're trying to answer within each of these sections. Some of them I think are going to be pretty self-evident. If you are a Better Investing style stock investment club, some of these particular items are not going to be up for contention within your club whatsoever. Others there may be some differences of opinions, and we'll certainly give you some guidance there. So you want to address your overall investment goals and objectives, the allowable types of assets. That's very important. It may already be defined in your partnership agreement or bylaws. The target asset allocation, especially with respect to asset types and portfolio diversification. The risk tolerance is always a good idea to address that. Portfolio and rebalancing guidelines, minimum investments that you might make in any investment within the portfolio, maximum commissions you might pay, stock selection guidelines if you want to be specific about the types of stocks that you're looking for or what are the criteria, and then finally some other considerations that you can make. So starting at the top level, investment goals and objectives, what is your club's primary investment objective? And the answer to make money is not valid in this context. Some of the examples of primary objectives include long-term growth or high yield or current income, total return, capital appreciation, capital preservation, for instance. These are just a few of the investment goals that a financial professional might work with a client working towards with their personal portfolio. I think most clubs would strive for either long-term growth or total return. A long-term growth portfolio might value growth over other criteria, whereas total return portfolio might incorporate more dividend paying stocks. So you'd have a yield component to your portfolio as well as the capital appreciation that comes from long-term growth. Many times I see clubs that claim to have a growth perspective, but don't hold a lot of growth stocks and hold a lot of dividend stocks. And again, that's fine, but your objective is not growth in that case. You might be looking more at a total return portfolio where you include some undervalued securities and dividend paying stocks along with growth companies that are selling at perhaps more expensive PE ratios. But understanding the primary investment goals that brokers and financial advisors use is part and parcel of the investment education process for individual investors. Allowable asset types is very important because there are a lot of negative ramifications for certain types of securities within a partnership framework or within a partnership framework that wishes to keep its tax preparation costs and paperwork to a minimum. So for instance, simply answer the question, what types of securities may or may not be purchased within the club's portfolio? You could prohibit certain securities. You could explicitly allow certain securities. So for instance, stocks or equities would almost certainly be an allowable type. You could also set restrictions on the price of a stock so that you might not hold a stock with a share price, purchase a stock with a share price below $1. The penny stocks are today closer, many professionals eliminate stocks below $5 as those low traded stocks that often don't meet the rest of our criteria. ETFs, commodities, precious metals, mutual funds, options, bonds, whether treasury, municipal, or corporate, these are all asset types that you might consider within your portfolio. And it's important to note that ETFs and mutual funds can hold many different types of securities. So they could hold stocks as well as bonds, cash, or other types of securities, so you can be more specific. If you're allowing ETFs, you might allow mutual funds and ETFs that exclusively hold or primarily hold stocks, for instance, might be considered acceptable. We always like to call out certain asset types like REITs, limited partnerships, master limited partnerships, royalty trusts, or other non-operating companies, as well as commodities and precious metals, or ETFs that own commodities or precious metals. These are difficult to account for in a partnership structure. They're going to complicate your tax preparation process. The real estate investment trusts, I see Miles has the question about real estate investment trusts. The reason that REITs are what we consider a stock security type to be avoided is that the distributions that are made by REITs on a quarterly or in some cases monthly basis, the makeup of those distributions isn't known until the following January, but yet partnership accounting requires a monthly recalculation of unit value so that every member gets their share of all of the distributions, income, expenses, gains, and losses when they are incurred. The problem is that if you own a REIT, you can only book that distribution more or less as a dividend, but at the end of the year, you've got to go back and edit it, and that each distribution might be made up of 4 or more different types of income, so dividends, return of capital, capital gains, etc. So in adjusting your books, now all of the transactions that happened throughout the year also get slightly adjusted. Withdrawals might get slightly adjusted of any members, and so it quickly can get messy. Now, if you just have one real estate investment trust in your portfolio and you're making this adjustment, maybe it doesn't have a significant impact on any particular member, but it does have an impact, and it does require the treasurer to do a lot of extra work in January. So we suggest that clubs avoid REITs in the club portfolio. Likewise, limited partnerships, master limited partnerships, these other security types provide for a lot of additional tax burden, and also you don't find out the dispensation of the distributions that have been paid until the fall after the end of the tax year. So that's great for individuals. That's fine, where you're not, you just want to know the total for the year. But for an investment club, it requires significant modifications after the fact to transactions. Yeah, if there was a REIT that only made a single distribution at year end, that would alleviate much of the concern, although you would still might not know the dispensation of that distribution. I imagine you would, and I imagine it might be suitable, but that's the exception and not the case. So related to the asset types, let's talk about asset allocation. How much, if you're going to allow different types of assets, how much are you going to allow to be invested in different asset classes? The stocks, bonds, commodities, real estate, cash, for instance. And again, most clubs are going to be 100% or close to 100% invested in the stock market. Some clubs like to sit on a certain amount of cash in their portfolio. So if that is the case and you want to make that a policy that you maintain 7% of the, no more than 7% or no less than 7% or something like that of the club's total assets in cash, you could certainly do that. And again, if that's your policy, you should make it part of the written policy. If that's the practice of your investment club, go ahead and quantify it. It's my belief that you don't need to sit on, no investment club really needs to be sitting on cash. Some clubs like to sit on cash to pay out withdrawals, so they've got a little cushion there. That's not required whatsoever in most cases, because nearly every club has a stock that probably should be sold from the portfolio if you needed to raise cash. Pretty much everyone knows the stock that is disappointing everyone is the easy choice to clean up the portfolio, raise the cash, and then reconsider that club at a future that stock at a future date when the club has more cash to invest. So pretty simple for most clubs. But if you are allowing different types, you might want to designate a target or a range of asset allocations for different asset types. The risk tolerance is, again, something that's difficult to categorize or to include in an investment policy statement, but the discussion is really important. What is the level of volatility that the club is comfortable with? There are lots of ways that we can define risk, and we have an idea for a webinar in our club series where we'll take a look at risk. We took a look at reward and risk in past sessions. But I think the key point here when you're thinking about it is that everyone in the club understands that in a long-term focused stock portfolio, it's important to hold those assets, hold those stocks through all the market cycles, through all the economic cycles, that you're not trying to mitigate risk by moving to the sidelines, by selling stocks, by holding cash, that you recognize the long-term nature of equities is always upward, and you want to capture those lower valuations during bear markets and benefit from the bull market that always comes after those bear markets. I think it's important to acknowledge the short-term risks in the market, but my view is the best way to mitigate those risks is to, in essence, focus on the long term. Don't pay attention to the short term. Don't worry about what's happening 3 months from now, 6 months from now, a year from now. Focus on what the likely outcomes are 5 years from now, 10 years from now, with each of the individual companies that you own in your portfolio. 5 Number 5 is our portfolio and rebalancing guidelines. How does the club intend to diversify its holdings? How will it rebalance? For instance, many financial professionals like to rebalance client portfolios once a year. So every year in December, they sit down and they sell the winners and sell the losers and bring everything into balance to match a pre-designated target allocation. And for most individual investors, if you're a long-term investor, this is probably not so critical, and I'm a big fan in an investment club of a dynamic approach to portfolio rebalancing, which is to say that investment clubs have capital coming in on a regular basis, so you've always got new funds to deploy. If you are underweight in a particular industry or company or sector, you have new funds that are becoming available that you can direct in those areas. If you are overweighted with large cap stocks, new purchases can be made of smaller companies, and this will improve your portfolio diversification over time. And I think that is a great way to look at portfolio balance and portfolio diversification. Better Investing suggests that clubs diversify their portfolios by the size of companies, so that you've got 25% of your companies being small companies, 25% being large companies, and 50% being mid-sized companies as measured by revenues. Also, Better Investing suggests that you diversify by sector and industry, so that you hold a number of different stocks in a number of different sectors, as well as many different industries within those sectors. So you could certainly look to identify the minimums and maximums that can be invested in any single company or industry or sector. I suggest that that you have 8 or 9 of the 11 total sectors be represented. It's difficult to find utilities or real estate or energy stocks that fit within a long-term growth stock portfolio. So that would leave you with 8 sectors, and that would give you a broad swath of the American economy. I also suggest that no more than 25 to 30% of your portfolio be in any single stock or any single industry. And again, you can make those definitions be as precise as you want. I think that adjacent industries, so a semiconductor company and a semiconductor equipment company, are very close. So if you held big chunks of stocks in those 2 industries, you're not doing a lot for the diversification of your portfolio. So these are important discussions. I think it's important to have these kinds of guidelines. It really helps drive portfolio decision making when you're looking at new investments that you can make. Related to that, you should answer the question, what's the minimum amount that can be invested in a single security? What's the minimum holding that you intend to have in any single stock? My minimum is 3%. If a stock isn't at least 3% of your total portfolio, it's not worth the time and trouble of following that stock and managing that stock within the portfolio to make it worthwhile. I think that you should be concentrated in your holdings and invest in chunks of companies that give you the most bang for the buck, and a stock that is 1% or 2% of your entire portfolio. If it doubles overnight and it gains 100%, the total impact on your portfolio is only 1 or 2%. And that seems like a very low payoff for a great investment decision. So that 3% rule is meant to keep you focused and keep down the number of companies within the total portfolio. I believe that as the club gets bigger and bigger, the dollar amount that you're willing to invest should get bigger and bigger as well, which is to say you start off buying $1,000 of stock at a time. 10 years later, you might be buying $5,000, $7,000, $10,000 of stock at a time. And so you need to be able to make those adjustments. And if you've got a 3% rule, that will keep your initial investments sizable enough that they really will have an impact when they perform well. The commissions aspect of an investment policy statement will tend to be much less pronounced than it was 10 years ago with the proliferation of low cost or zero cost brokerages. My rule of thumb is to keep commissions below 1% of the total cost. So if you are paying brokerage commissions, you want to make sure that you're not investing small amounts and racking up commissions that are above 1% of your total investment. Number 7 is our stock selection guidelines, and this can be as detailed or as broad as you wish. If you are following the better investing methodology, you might set up your criteria for any stock that's considered, for instance, that has a history of positive sales and earnings growth and likelihood of future growth, that the pre-tax profits, pre-tax profit margins are stable or growing, that it's selling at a reasonable PE ratio, that the reward to risk ratio is greater than 3 to 1. Just some examples, and you can be as specific and as detailed as you would like. And I'm assuming that you have some familiarity with the stock selection guide in order to make those determinations. And then finally, there are other considerations that many clubs like to undertake. For instance, are you interested in ethical or socially responsible or green companies? There's a lot of conversation coming on for many companies that are looking at their sustainability goals and looking at the overall health of the company from a climate perspective. If those criteria are important to you, they can be included in the investment policy statement. If you would like to eliminate vice stocks or stocks in particular sectors or industries, some investors like to stay away from firearms makers or tobacco companies or defense stocks and military stocks. If that's the case, again, you can incorporate that in your investment policy statement. Some companies, some clubs like to look for local companies, look in their own backyard, and that might be something as well. And again, as with all of these, the way that you frame your investment policy statement doesn't have to be an absolute. You don't have to say we will always select companies that are ranked high for social responsibility. It could be that the club will consider these elements when looking at the stock, so force you to pay attention to them. That's, again, perfectly fine within the context of an investment policy statement. And so those considerations, I think if you review them, would help you gain a lot of clarity for all of your club members. And so the question comes up, what if you violate the investment policy statement? Well, I believe that your club should unanimously adopt it, and that means all members agree about the investment policy statement. And if there comes a time where you act in a contrary manner to the investment policy statement, then it becomes important that the club is unanimous in the decision to act outside of the realm of the preset policy guidelines, right? Because what you don't want to happen is you've got an investment policy statement, a member is away at a meeting, and then the rest of the club members during that meeting decide to make an investment that goes against the investment policy statement. If I was that absent member, I would could be very upset in that situation, and that could put the club into some precarious legal situations. So I think it's important that if you go this route, that you stick to it. And again, if it's not working out, you can revise it, you can withdraw it, as long as the club members agree. The great thing about a partnership is that it's that the way that they're constructed, if all the members want to do something, then that's how the partnership operates. So you get to determine what and when and how you implement the framework of the policy statement within the club portfolio. So just a couple of final tips. I know that Christian asked if you can find any sample investment policy statements. If you search on the internet for investment policy statement example, you will find a lot of examples from financial professionals, from financial advisors, some samples that you can review and understand a little bit better how they work. Remember that you don't need to be specific, especially right out of the gate. You don't have to be perfect right away. And I definitely suggest that this document becomes part of your new member prospect packet that you share with potential candidates for your club. So let me talk about some other questions in the questions box. Marilyn says, yes, our small cap informer recently covered a real estate investment trust. We cover a couple of them in our mid-year review. We talked about Innovative Industrial Properties, which is a cannabis-related real estate investment trust. And in the Investor Advisory Service newsletter, we also cover a couple of real estate investment trusts. Every time we cover those in the write-up, we include a little some language that recommends that clubs, that this is a recommendation not to be deployed within an investment club framework because of that. I'm a big fan of REITs. I love REITs. I think they're a great way to diversify. Standard & Poor's just a couple of years ago decided that real estate was such an important part of the economy that they broke it out of the financial sector as their own sector. So they're, S&P, Standard & Poor's is looking at REITs and saying this is an important part of the economy that investors should consider. But the problems with club accounting just make them not suitable in a club portfolio. You can study them in your club, talk about them in your club, have individual members purchase them in their personal portfolios, but just keep them out of the club portfolio if you want to keep your club treasurer happy. Jesse says, what are the 2 or 3 sectors that are hard to invest in? If you are a long-term growth stock-oriented investor, stocks in the energy sector, in the utility sector, in particular, are difficult to find. Utilities companies tend to be low growth opportunities with higher yields. They can be an important part of your portfolio, but they also are not absolutely great to hold during raging bull markets. They're defensive, part of the defensive sector, and energy stocks, as you may be aware, run on their own cycle. And again, so they tend not to be easily evaluated on the stock selection guide. So again, I understand if you think that you want to pursue those in your club portfolio, but they're difficult within the Better Investing framework. I don't think it's absolutely necessary that you replicate the sector diversification of the S&P 500 index in your club portfolio. So omitting a couple of the sectors, I think, is fine to do. Bonnie asks about ETFs holding precious metals. The gains from an investment in a precious metal are taxed differently than from stocks. So even though the ETF trades on a security exchange like an equity, like a stock, it is not a stock, and the gains from that ETF would need to be reported as personal income at a different rate, and so it's not something that's supported in in our 1065 club tax printer software. So that's why we suggest that you stay away from commodities in a club or precious metals in a club, as well as ETFs that hold those particular types of assets. Just complicates things.
Doug, there's a further complication.
Yes, Russell.
These ETFs often sell some of the precious metal or the commodity, and it's considered that the holders of the ETF have sold some of that commodity. So every time your ETF sells some of the commodity to cover expenses, you have to account for it in your accounting, and that's really hard without changing the number of shares you own or doing it. So that makes it even harder to account for.
Got it. Thank you, Russell. Joe Farrell points out that the other the problem securities that we identified, like master limited partnerships, might also require your members to file extensions to their personal returns, because the club won't have the information from those types of securities in time to file a timely partnership return. So you'll need to, or even if you can make and so it'll require your 1065 to be filed, request an extension for that 1065 as well. So thanks, Joe, for that. Marie says, explain more about what you mean by keeping commissions to 1% of the total cost. Well, in the past, I would occasionally run into a club that was using a broker that charged $30 for a commission, and they were buying $300 of stock, and that's at a time. So 10% of their investment was going to commissions. And then they were wondering why none of their purchases seemed to ever be making money. Well, if you're expecting a stock to have a long-term capital appreciation of 10 to 15% a year, and you're starting out 10% in the hole, well, it's going to take at least a year to earn enough money to net the commission out of your total investment. So if your broker charges you $10 for a commission, then that means make your all of your purchases be at least $1,000, because $10 is 1% of $1,000. So it's not as much of a problem these days as it used to be, but it still is a consideration. If your broker is charging commissions, you want to make sure that you're not starting out so deep underwater that it makes it really hard to earn back the commission that you pay on the cost of your investment. Steve asks if the investment policy statement should be part of the partnership agreement or bylaws. I think it's a separate document. I think we treat it the same as the partnership agreement and bylaws, as one of the governing operating documents of your partnership. I think that's the best way to think of it. That way you don't have to revise. I'm a fan of having a partnership agreement that is very broad, and then bylaws that are specific. You can amend the bylaws a little more easily, and I think the investment policy statement kind of fits with that. You can amend that investment policy statement over time without having to redo your partnership agreement. That would be my approach there. Kim says, should the policy statement also include parameters, guidelines for selling stocks, selling investments from the portfolio? And again, I think that is probably a very, very good suggestion. I think it's also the topic that will create the most debate within a club of more experienced members, because the reasons and rationale for selling are very complicated and in many cases convoluted, and people bring a lot of different opinions to the subject, but which is why I didn't include it. But feel free to go for it. I think that it's important to have some consistency in your selling approach, but that's often very difficult for clubs to come by. Again, I cover when to sell a stock on a frequent basis at chapter events and in our webinars, and we have some tools and ideas on how to do it productively, and we've covered it in terms of investment clubs as well. So that's we'll leave that one kind of open-ended for your particular discussion. And with that, I think we're going to wrap up our presentation tonight. A little bit early, but that's great. It's a hot August night. We hope your clubs might be taking the month off, but we wanted to continue with our education series. If you have any questions, feel free to reach out to me or our team at iClub.com. We wish you the very best, and we'll look forward to seeing you at our next Investment Club webinar.